as far as the yin yang, the two sides of the coin, we have the next two stories are essentially the two sides of the same thing. The S&P being at all-time highs, or recently crossing all-time highs, and the problems of what we're seeing in the treasury market. Now, I don't want to delve too deep into what are the underlying mechanics of what's going on in the markets, but I just want to point out a few things. So recently we had something I pay attention to are the bond auctions. We have here a bond auction for the 3-year, the 10-year, and the 30-year that happened this week, and you'll notice that the yields on those bonds are higher than they were last time, which means that basically the higher the yield, the more the treasury market has to solicit buyers. That's why the yields are going up. They have to pay more out to to nations, to institutions, to whoever, to bond buyers in order to get them to buy the bonds. And this is a gauge for, it's like inflationary. Those numbers going up means that um, people feel there's a higher chance that inflation or that interest rates will be higher in the future, and so they don't want to get a lower interest rate now. So it's like nerve wracking. It's like, okay, well, we were talking about, I think last week, that perhaps we've bottomed in yields. At least that was the case I was making, that we bottom in yields, and that we might actually head up to higher yields, higher inflation rates than we had during COVID. And this to me is like signs of that rumbling. We add on top of that the one second. We add on top of that the idea that the Treasury, the Move Index, which is essentially the VIX but for bonds, exploded up recently. I don't know if you saw this. The Move Index just jumped up significantly.
Mm-hmm.
And that's nerve wracking as well, because that means, I mean, the Move Index can move up just like the VIX, whether the bond market does really well or it does really poorly. But what it means is that something's happening. And what actually happened was that yields went up, which means it suggests there's a problem with funding somewhere. Somewhere in the financial system, there's problems with the value of collateral and the ability for institutions to fund themselves, which is why we're seeing these stirrings. And that to me gives 2008, gives 2012, gives 2019, and gives 2020. You see these rumblings before major crisis, but here we're seeing it in the bond market. I don't like that. I'm fine with the stock market crashing 50% or 80% and staying that way for 10 years. Fine. We all know how to live with that.
Mm-hmm.
But if the bond market goes down, that's sovereign debt that's now at risk. That's a real big problem.
I found it pretty interesting as well. And it's obviously had a secondary effect or second order effect on the mortgage market as well. I was sharing my overall yield curve chart with you there on treasuries and the Fed funds rate, as well as the current average mortgage in the United States. And obviously this graph is telling this short-term story here of the, sort of midterm yields rising pretty significantly over here, the 1 year, 2 year, 5 year, 3 year. And then of course the shorter term 2 month, 3 month, 1 month yields have remained relatively flat and started to decline as expected, but it's also caused a clip up in the overall average mortgage. We went from, sort of a bottom of 6.09 to 6.32 on average. That surprised me. I expected that as the Fed pulled back by 50 basis points, we'd have a little bit of a lag in the rest of the mortgage market, as well as credit or yields in treasury yields, but that wasn't the case. To your point, we've seen this big uplift overall in the overall forward curve.
And the news is all like strange about it because, right, the Fed cut 50 basis points because they want, one of the things they want is for mortgage rates to come down. They want to release that pent up demand. So that's not exactly happening the way they're thinking. Plus, they're floating out the idea there that they might not do the next rate cut. I don't know if you saw this. I think Boston came out. President Boston came out and was saying, "Hey, maybe we shouldn't do the next 25% rate cut." And I think the odds dropped from like 75% to like 65%, something like that. And so that's like, wait, I thought you were cutting to stimulate, and now you think you shouldn't do that. And what is going on here? Why are we getting this hot and cold? How are we getting problems in the treasury market, but stock market at all-time highs? How are you saying a month ago that you want to increase liquidity and that jobs are okay, but then we're seeing weaknesses in the actual like physical economy? Jobs are up, but number of jobs per person is up as well. It's like you have all this information that's like contradictory, and I can't tell if it's we're being fooled by the good data and things are bad, or vice versa, or if it's good for some people and bad for other people, and we get this like bifurcation, this K-shaped economy. I don't know what's going on, but it is making me nervous. There's
Agreed.
the
I think
probability
there.
here, right? Sorry.
Yeah, I was just going to say the current expectation, at least from the futures market, is that there's still about a 90% chance that we'll see another 25 basis point cut on November 7th.
Okay.
That said, you can kind of see as we get through the historical chart here how those probabilities have changed, and it's right up until the first week that we actually saw a lift here to almost that 90% mark. Interestingly, though, I mean the futures market tends to be pretty spot on in terms of its predictions for rate cuts, but their accuracy is closer to the actual date. So give it, I'd say, another 3 weeks, and then check the CME FedWatch tool, and you'll have a different story to rely on.
Well, I just wanted to read these just to finish it off. I wanted to read a couple of these tweets that were talking about this, what we're seeing in the treasury market. I thought it might be interesting. So here we have Convexity Maven, who is Harley Bassman, he's the one who created the Move Index. And he says here, bond market worries of post-election panic. The Move Index measures the implied volatility of a constant 1-month bond option. On Monday, the election fell into this 30-day window. So this jumped the move from 100 to 124. The market is bracing for an 18 basis point rate change on the days after the election. Similar equity options jumped up by 20%, and so on and so forth. So essentially, the election here seems to be a big kicker that now that it's actually being factored into the volatility surface, there might be more that happens after the election than what we're normally used to. Here, Jim Bianco, who was considered to be, I believe, part of the to be one of the presidents of the Fed, if I'm not mistaken. The Move Index is again back into rarefied air, more than one standard deviation about its long-term average, about above the shaded area. Take this as a sign that, again, the bond market is under a lot of stress. And then finally, this tweet from Cross Border Capital: jump in the move, not a great sign. Expect policy actions to rein it back. But is this finally saying that there is too much funding at shorter end of term structure? Hashtag monetization. So when I hear people that I respect start, worrying about what's going on in the bond market, that's where I know, okay, generally it's a long-term thing before it plays out, but it's something to pay attention to. But with the S&P at new all-time highs, I think what we were talking about last week from Kevin Carson, that we might expect a Santa Claus rally into the end of the year, and then basically market up, vol up until we get to end of January, between January and March. That could be in the cards. So when, as we're wrapping up here, I will love to jump to a Bitcoin chart, because that's a great indicator for risk, great indicator for liquidity, to get a sense of what you think we are, if we've bottomed, if we're sideways, or if we're right about to rip roar.